Hi everyone, thanks for joining. Today we've got a cryptotax live stream with Koinly and Cointree. The reason we're doing this right now is obviously the upcoming deadline for personal tax returns is 31st of October. So we're going to chat a little bit about tax, and just to introduce everyone today, so we've got Andrew Maroulis.
Close enough. Yeah, hi everyone. Really happy to be here. Yeah, I'm head of product at Cointree, and also been involved in quite a few crypto tax returns over the years. So yeah, looking forward to it.
We've also got Adam Saville-Brown.
Yep. Hey everyone, I'm Adam. I need to get a new headshot, one with shorter hair and slightly chubbier. But we'll do with it. But a pleasure to be here today and talk about crypto tax.
And myself, I'm head of tax here at Koinly. So we're going to dive straight into it. Just a small disclaimer. Obviously, we're not financial or tax advisors. So the information we talk about is going to be for educational purposes only. If you need advice, obviously speak to a qualified accountant. And we'll put the recording on YouTube afterwards. So really the purpose of this session is to get into the weeds a little bit with some of the current ATO guidance on crypto. And just to understand some of the interactions with DeFi, airdrops, all the various nuances that can be confusing for tax time. But we also want to just set the landscape of where we're at, and hear a little bit from Cointree and what we're seeing in terms of market trends as well. We'll talk a little bit about software at the end and then take a Q&A. So I think firstly, we just want to set the scene because obviously we're in a time where crypto has grown. We're obviously in a bit of a bear market at the moment, but I think what's clear to me, having been to a lot of events in the last few months and speaking to a lot of people in the space, that the level of innovation isn't dying out, right? There's a huge amount of building going on and a huge amount of positivity about the future of crypto and digital assets at the moment.
When I got into startups back in 2008, it was just after the dot-com bubble. And I remember this key phrase where they say there's never a bubble in technology. It will constantly be evolving. And we're seeing that now with crypto just developing at the speed. It's doing like a lightning run through the banking industry. Yeah. And it's really awesome to see.
Yeah, it is that kind of feeling of a speed run. But some of the things that are, and there is a lot of building and innovation going on, but there's some really cool things, especially on the UX layer. Things like the whole custody challenge with wallets and all that sort of stuff. So there's some really exciting stuff on the innovation front on the horizon. But it also looks like there's some, hopefully, positive looking tax changes for us here in Australia that might be on the horizon as well.
Yeah, absolutely. And we're obviously, Australia as a country really punches above its weight on the international scale for crypto adoption as well. And we also have a very active tax authority in the ATO. And we're currently in a place where a lot of people are engaging in DeFi or gaming, and there's not clear guidance. And so some of what we wanted to do is just cut through some of that today, but also address actually where the areas of uncertainty are. I've put on this slide here, tax obligations aren't always clear. There's a lot of complexity, and currently we're seeing that unravel, and that will keep going as we move forward. So we got a little bit back to basics first with Andrew.
Yeah, so these are just a few trends that we're seeing over the last at Cointree with just how our customers are interacting and just general themes in the market at the moment. So it is indeed back to basics. Like I think probably everyone on the stream is familiar with the market conditions we're in at the moment and some of the drama and trials and tribulations over the last few months, particularly in crypto. So I think as a response to that, what we're seeing is people really going back to basics. And one of those things is, there's a very heavy slant, which probably surprises no one, but for Bitcoin and a side order of Ethereum, right? So, even in a bull market, you see these as the primary assets people buy just because they've been around the longest. But, in the market we're in at the moment, people are sort of, going back to those, I guess, more trusted and more sort of long-term assets, which are probably, as far as crypto goes, fairly risk-off, as far as crypto goes, asterisks.
What's the thing people check? Bitcoin dominance index?
Yeah, which is interesting this time around. It, hasn't, generally when we have downturns, BTC dominance goes a bit higher. So,
yeah, right.
That raises a few questions as well. But still, people are going back to, the perceived safe assets as well, which is, I guess, no surprise. I think the second one as well is DCA, which is dollar cost averaging. I mean, just for those who aren't aware, it's basically any asset class outside of crypto, where it's probably the easy mode, low stress way of investing, where the theory behind it is it's more or less impossible to time the market, particularly, time a top or a bottom consistently. I mean, even professionals who spend all their time doing it can rarely, if ever, do that. So the idea is, if you've got, $100 to invest a month or whatever the amount is, you just, put that $100 on every month on those assets that you're bullish on. And over time, it's very, very likely that you'll outperform people trying to time the market. So it's kind of that low stress way. And that's exactly what we're seeing is, people just making the regular buys, kind of like the BTC ETH thing. It's kind of come back into favor more as the market's kind of consolidated a little bit. So yeah, I guess, again, not the most exciting thing, but it's a tried and true method that, people revert to. And the next one as well is stable coins, particularly, USD obviously has been on a tear recently. Anyone who's been observing the macro conditions, it's very strong at the moment. And a lot of people have obviously realized that, buying a stable coin is actually a really good way to get exposure to the US dollar. So yeah, that's something where, of course, we're assuming that's one of the reasons, but, we're definitely seeing an uptick in stable coins. And of course, stable coins have a lot of utility out if you're using DeFi and that sort of thing. But as we've learned recently, not all stable coins are created equal. So of course, do your own research there.
Yeah.
Well, it's sovereign currencies as well. I was looking at the pound against the US dollar a couple of weeks ago, and it looked like a rug pull on the charts.
Yeah. It's like, what coin is this? Yeah. Right.
It's interesting, looking at the stable coins and how they're kind of becoming more used in everyday situations. Like I'm even starting to see invoices with payment options for like USDT, which is pretty awesome to start seeing that coming into like the business world. And even with, like, if you look at the digital finance CRC that was funded over in Sydney, that's working with the RBA to try and look at an Australian stablecoin.
Yeah.
It's pretty interesting movements.
Yeah.
All right, so let's shift the focus a little bit to tax. I think firstly, let's just understand, obviously what gets caught in the tax net from a crypto asset perspective, and we'll start a bit basic and then ramp up a little bit. But it wasn't until recently that the ATO actually recognized that crypto is more than just Bitcoin. And initially, when we started getting guidance in 2014, all of the ATO guidance actually referred to crypto as Bitcoin with the main example. And I'm highlighting here that there's a range of assets that take various different forms that are seen as crypto assets. And if you're an investor, that will be a CGT asset. And we'll talk a little bit about that a bit later. And I think the key thing as well is these assets aren't seen as foreign currency under the eyes of the ATO. And if they were, they wouldn't be treated under capital account for investors. So capital gains wouldn't apply. And you'd potentially have a situation where you have, crypto losses that can be offset against salary and wages. And at the moment, that's absolutely not the case. So the ATO see crypto as a CGT asset, and it falls under that regime, which is separate to funneling everything under income. And so, you've obviously got your core kind of more cryptocurrency type coins, and, categorizing crypto is actually a really hard thing to do. I know Treasury are attempting it at the moment with token mapping, and I don't envy the job they have to do because it's also subjective, right?
And it's changing all the time as well.
Yeah. And I think by the time that token mapping exercise finishes, there'll be new categories of tokens that we probably haven't even considered.
Yeah, that's right. Yeah, and there is, there's a few new standards that have come up recently, like one for yield-bearing assets, and you name it. There's new token standards being, kind of put forward and sometimes adopted. So we don't envy the regulators trying to get their heads around this. Yeah,
exactly. And some of the examples I want to call out here is obviously stable coins. People see in the crypto ecosystem stable coin as the best thing to fiat currency, right? A lot of people will just never cash out to fiat currency. But if you're moving into stable coins, that's a separate CGT asset. You've got a taxable event when you move in and out. But you've also got asset-backed tokens, which are more commodity-based. So PaxG has, I think you get one ounce of gold for one token, and you can redeem the gold if you actually want to take delivery. There's obviously game tokens that hugely complex in the way that you can acquire them, NFTs as well. which we've seen a lot recently in the last 12 months.
I think that was one of the more interesting parts of the CryptoCon that was up in the Gold Coast a couple of weeks ago, was seeing all the different projects like live in one location was pretty awesome.
Yeah.
And do you remember the game station that was there as well? Like 2,000, 3,000 people just waiting to play these games.
Yeah, and you like from a tax perspective, there's some pretty funny scenarios that might come to mind. If your 8-year-old son or daughter happens to get really lucky, like landing some really rare loot and then cash that in, like how does that even work from a tax perspective?
We actually had an article about that because we had this kid came to the booth with his dad, and basically we were talking to his dad and we're like, oh, what are you doing here? He's like, well, my son's been making all this money playing games. And he's like, so we're here to try and work out what to do. And the kid was like YouTubing, TikTok, playing DeFi games, yield farming.
Yeah, and there's huge complexity. You've got under 18s that are earning income through games, and that's an issue that's currently being worked with at the moment in the industry. And there's going to be more and more, as you say. And I think token mapping in itself, which is an exercise that Treasury are doing, is a tough job, I think, at the moment. So with this increase in adoption, the pressure on authorities has increased. Not just on the exchange side, but also for investors. The ATO actually called out that crypto assets are a priority, and reporting gains around crypto are one of their 4 key priority areas this tax time. So worth bearing that in mind. If you haven't done your return yet, you hold a lot of crypto. It's something that is on the ATO's radar, and I think it's important to recognize that.
Yeah, well, if you haven't done your report yet for the ATO and you want to use Koinly to help do that, then we got a code for everyone on the stream today, which is Cointree 22LS, and we'll drop it in the description as well. And that's 500 free reports for people that are watching the stream or watch the video afterwards, and 30% they're off after.
Awesome. And I think then what comes with this pressure on individuals and corporations on reporting is it's not just saying, well, let's get to the right number for your tax return. It's how can you demonstrate the evidence around your record keeping? Because ultimately, if the ATO asks for your records, you have to produce them. It's a self-assessment regime. So really having strict record keeping is important. But also on the exchange side, we're obviously seeing data matching programs with the ATO and Australian exchanges and AUSTRAC requirements as well. I'm sure you're seeing a lot there. Yeah,
absolutely. And it is just simply a condition of operating an exchange in Australia. So it's one of those things that is there. But it's, on the record keeping thing as well, I think I've often heard the debate that, crypto by nature, or layer 1 chains, they're sort of open ledgers, right? But that doesn't always sort of cut it in terms of the level of record keeping that you need. So what I mean by that is all past transactions are visible to anyone with an internet connection. It does get a bit more complex than that, though, as we'll dig into shortly.
Yeah, absolutely. And as a result of these data matching programs and information feeds, not just from exchanges but also banks, the ATO will likely know you have crypto before you even go to do your return. So that screenshot is an example of what you'll see when you actually log into your MyGov account to do your tax return for the first time. It'll actually say you might have held crypto. And that's how they're getting the information, essentially, through those programs. So we'll jump into some of the guidance. Firstly, I mentioned 2014 was when we started seeing some guidance. We started really kind of getting more traction actually in the last couple of years. So I want to fast forward to 2022 because we're having a board of tax review at the moment, and essentially board of tax are tasked with firstly going to industry to understand what are the issues in this space. Obviously we have a situation where you've got crypto assets that are funneled into an existing CGT regime mainly for investors. And because the way in which people are trading crypto is so new, and intentions, use cases, and volumes, for example, it's very, very different to what you might see for shares or rental properties, which are all CGT assets as well. This review is going to capture some of the issues at hand and we at Koinly have been feeding into that review and working with the board of tax
Danny,
as well.
I was going to say, I've never seen someone have like a spark in their eye and like smile so much when talking about board of tax review. I saw you looking at it, and I knew that was coming into your mind.
Yeah, I mean, it's been a great way to, I think, certainly from our perspective, to just voice a lot of the issues we see in this space, or concerns that firstly our users might have, and confusion on what they actually need to do for their tax return if they're playing games or they've engaged in various different DeFi protocols. But also working with accountants. We're working with a lot of accountants that use Koinly, but often struggle to interpret some of the tax treatments. And so being able to feed that back, I think, has been really valuable.
Actually, yeah, on a product level, we actually built a version of our platform for accountants, because what we found was people were just getting reports, and the reports kept having Koinly on them, and the accountants were reaching out to be like, look, what is this? And so we've got a different layer on it for the accountants.
Yeah, it is even like, just as a sort of crypto user, it has been tough over the last couple of years to find an accountant who's available. Of course, there are ones out there who do understand crypto, but generally, can have wait lists.
And it's really tough because accountants are also being pushed into this space. A lot of them aren't actually trying to go and target crypto as an industry, which might be a smart move because it's going to keep growing. But it's more a case that people are having clients come to them with all these DeFi issues or gaming issues, and they don't really understand what crypto is in the first place. And so it's always worth going to an accountant that understands crypto and the way in which you're trading with your crypto assets.
We have a directory on our website of like crypto-friendly accountants and people that use us. And it's interesting because one of the things that we do is we go and actually speak to accountants and talk and do kind of webinars like this, but for the accountants and the big practices. And on the first one, I think Danny and I did, a lady came up to us and she's like, you can't pay me enough to do a crypto tax report on my own. And she's like, how many lines of just transactions they have to track is wild.
It is. And I think that's why, personally, I'm quite excited about hopefully some of these changes coming through, because I think it is the nature of, like, Danny mentioned before, it's kind of the old rule set which works for shares and property and that sort of thing aren't necessarily a very good fit for crypto. And the reason for that is, by its nature, a token or a digital coin has a lot more sort of utility and composability, which means there's all these crazy kind of, use cases that are people coming up for that just don't apply to that old regime.
And one use case for an individual, take NFTs, for example. Someone might love the NFT as artwork, but someone else might hate it and hold it for an entirely different reason. And that doesn't even bring into context business intentions either. So there's huge complexity in this space at the moment. So one of the things you have to do when you actually understand the way in which you're taxed is to work out whether you're investing as an investor or whether you're actually carrying on a business, and we call that trader. And there's two different tax rules that generally apply, whether you're an investor or a trader. Now, most people that trade crypto on the side, that have a full-time job, and have crypto as a side investment, or even if you're transacting regularly, you're likely to fall into that investor category and be subject to capital gains. And to be on the business threshold, and there's a lot of existing case law on this, but just broadly speaking, you really have to be demonstrating that you're running a business operation or a business-like operation. And so, whether you have a strategy in place, whether you've kind of got commercial purpose behind the way in which you operate. And I think what I'd say is, there's often a bit of a misconception here. A lot of people think that they can just run a business, and if they've minted a couple of NFTs and they start trading it, they're running a business. And that's generally not the case. I think you don't get to choose whether you're an investor or a trader. It's more the facts and circumstances that surround what you're doing dictates whether you fall in one or in the other. But it's also not black and white. And so, there are issues where accountants might receive Koinly reports and look at these volumes and say, well, you've traded 200,000 transactions in the year. There's no doubt you're running a business. And that individual might have just been gaming, so they might so
bot trading.
Exactly.
We get that all the time.
Yeah, It's also, like, especially when you're transacting on chain, one sort of, I guess, intended transaction can actually be multiple on chain, which shows up on a report. So it can skew it. So you're right, it's a bit of a grey area.
And that's different to traditional finance in a way, because we can generate so many taxable events through the crypto ecosystem that it's just very different to when you go and you buy shares through a broker. You might sell those shares, then reacquire something else, but there's still hoops to jump through. Whereas, especially with the UI and user experience of exchange apps these days, you can just click a button and you can move in and out of different assets in seconds.
That's right. And I think one of the other sort of interesting, complications when it comes to tax is there's certain things that might happen behind the scenes when you're using a DeFi protocol. Like, it might do certain things like split them, send them in a certain direction. But on the UI layer, it just looks like a single transaction. So, at what point, how does that then work for reporting? And
I was going to dive into that a little bit later on, but it's worth mentioning, often the user experience of how you're interacting with the crypto ecosystem doesn't reflect the taxing points. And that's what leads to a lot of confusion when people actually plug in software afterwards and they look at, oh, well, why do I have all this tax on transaction fees when I was just moving from my exchange wallet to a Trezor device? And those interactions and ways in which people might be thinking or experiencing how they're interacting with crypto don't necessarily reflect the tax outcomes yet.
Yeah. It's probably also worth calling out as well, like some of the things we're discussing. If you're fairly new to crypto and you've just sort of purchased a couple of coins on an exchange and may have done the odd buy and sell transaction, a lot of the stuff we're diving into won't apply, right? So I guess you don't need to worry from that perspective. But the more you sort of get involved, particularly transacting on chain, that's where the complexities and grey areas really come in.
So I want to just touch, obviously, still on the basics, but just when a taxing point applies for an investor. And most of this discussion will be catered to people that are subject to CGT as an investor. So you get a capital disposal event when you sell or gift crypto. That's pretty straightforward. When you trade or exchange, that's more of a gray area. People don't often realize when you're trading from Bitcoin to a stable coin like USDT, that's actually a disposal of the Bitcoin. So not only do you need to record the value of which you've disposed the Bitcoin, you have to understand the purchase history of that Bitcoin, whether you've made a gain or a loss, and work out where the capital gain applies. Obviously, converting to fiat currency, that one's pretty standard. But what a lot of people are doing now is spending cards and just going to the grocery shops, shopping with their crypto cards. And there's different types of those cards around. I've seen debit and credit type cards. And those can be taxable events. And, it's something that people often don't realize because they think they're just spending crypto like it's in their bank account, which is obviously not traditionally a taxable event when you just have your money and you tap away on your debit card. So that's something to flag. And, it is an area of confusion. And not only do you have to worry about those kind of taxing points, but you have to record each transaction. So it can become a pain. Aside from that, you've also got situations where you can generate income on your crypto assets. So even though it's a capital asset, when you dispose of it, you have to work out whether you've made a gain or a loss. Certain income generating activities mean you have to pay income tax on revenue account at market value when you receive it. So staking is one of them. If you're staking ETH, for example, even though that underlying ETH is a CGT asset, that staking reward is taxed at market value when you've received it. Now, there's some gray areas around what when you've received it means. And, I know some protocols you can claim ETH or you have to essentially claim your staking rewards. Others, it drops into your account. And that's probably a bit more straightforward. Other ones auto compound. So you don't actually claim it or it drops into your wallet. It just goes under the underlying capital base.
Rocket Pool's one of those as well. Yeah.
Exactly. And so, at the moment, all we have from the ATO is it's taxed at income when received or market value when received. And so, I think what we've sought, particularly from the Board of Tax Review, and we might see more clarity on this soon, is just around the timing. Is it when you hit claim? Is it when it drops into your account? What happens when you have auto compounding? You've got a lot more complex earning interactions now, obviously with DeFi, borrowing and lending. Staking is probably more of a vanilla example. But then you've also got apps that allow you to earn through stepping. I think there's learn to earn now as well. And obviously those are all potential income generating taxing points. So it's just something to be aware of. Often people don't realize this until they plug in software again. I also want to call out that we're in a bear market at the moment. People might be up for tax on their staking rewards, but the underlying value of their asset might have dropped. And so a lot of people have a situation where they can't offset that loss they might have made during the tax year against the income that they've had to pay, or income tax essentially on those staking rewards. And so you can't offset the two. And so people are generally feeling a bit hard done by. We end up with something called a dry tax charge, which often people have to put funds aside to actually pay their tax bill for staking rewards. And people don't actually realize that they have to pay tax on their staking rewards. So they don't actually forward plan and keep the funds, which can lead to trouble down the line. Obviously we've mentioned CGT. I think this is just a very basic, what is it? And it's essentially the difference between your cost basis, purchase costs plus fees. You're allowed to include transaction fees in there, less the value at which you sell it for, which gives you a gain or a loss. I'll just call out that if you hold your assets for longer than 12 months, you may be eligible for a 50% discount on your CGT. So that can come in quite handy. And obviously your capital losses can be offset against capital gains. And you can bank those losses. So a lot of people that made a disposal during the tax year definitely record that, because it can be useful when you make gains in the future. So some common pitfalls. I think we were talking earlier about, obviously the blockchain layer ones, but the tech is inherently traceable. A lot of people think you can, if it's in my wallet, no one can see it. But if it's on chain, you can see it.
Everyone can see it, yeah.
And we saw that with, I think the Celsius event was slightly different, but, I think a lot of Celsius wallet holders have had their accounts doxed through the court filings. But, it doesn't need to get to that stage. Blockchain technology, whilst your ID and your name isn't tagged to your wallet address or your MetaMask, if you've got transactions from an exchange that requires KYC and AML, so know your customer.
Just got to connect to one, and then it gives the whole connection.
Absolutely.
There's some really complex, should we say, chain scanning tools out there as well, which are evolving, I guess by the month at the moment, which can trace those types of transactions. On an interesting side note, there was the whole recent, I guess, drama around Tornado Cash as well, which is, so there's a lot of things happening on this front. But I think that the number one rule is, it's probably a blockchain, and crypto is probably the worst place to, hide an asset, because, it's all on a ledger.
Yeah, and then, companies like Chainalysis that have these advanced blockchain scanning tools, and it's very, very easy with some resource to actually unravel those transactions. So definitely not the place to hide. Crypto to crypto transfers are taxable. We kind of talked a little bit about that, but often people don't realize if they just want to transfer some of their ETH to a stable coin and then acquire another asset, that's multiple tax events. An investor can't offset capital losses against your income from salary and wages. So I will highlight that comes up a lot. A lot of people think that they can just, if they've made a capital loss, offset that against their salaries. It's just not the case if you're an investor on capital account. Crypto spending cards, again, we talked about that. There's a personal use asset rule out there that a lot of people think this spending card fits into, and the ATO have actually clarified that it's very rare to get exemptions under personal use asset rules, and we can talk a little bit about that later on. And staking is taxed as ordinary income. So just some other things, and we can get more into some of the details here, but wash sales, if you buy an asset, sell it very, very quickly just to create a capital loss, then you're likely to be denied that loss by the ATO. So you got to be very, very careful, particularly as the market's been on a downtrend before the end of tax year. I think this is going to be on the ATO's radar. So don't try and claim a capital loss if you've only sold your asset with the intention to create that loss and then bought it very quickly. Having said that, if you've sold it and bought another asset with it, then wash sale won't apply. So it's just a case of understanding the rules and knowing where you lie.
Yeah, and this is the one of the things. Of course, I had to do a crash course in just learning all things kind of tax and crypto once I tried to do my first, return with a crypto portfolio. And I guess the easiest way of explaining that is if you are kind of ending your position in a token or coin, that's fine. But if you are just simply selling it to, I guess, harvest that loss, then buying it straight, buying the same asset again, that's the definition there, I think.
Yeah, and I've definitely seen some kind of, don't take advice from Reddit, because there's definitely some strategies out there that aren't compliant and wash sale rules apply. So yeah, worth keeping that in mind. Personal use assets. So I mentioned that very briefly when we're talking about spending cards. So there is a rule where if you've bought an asset under 10K, capital gains is disregarded if the item was bought for personal use. So a lot of people think, my spending cards fall into that category, and capital gains won't apply. Now, the ATO is actually, they actually updated their guidance on this again recently just to provide some new examples. But essentially, if you're holding your crypto for any significant length of time, and significant length of time can be, essentially to hold it as an investment. So the longer you hold it, the more likely the ATO are going to say, well, it's an investment, and so it wasn't bought with the intention for personal use. It's unlikely you'll be able to use that. And so, I think there's an example out there where if you want to go to a concert and you buy a ticket in crypto to get a discount, and you don't hold any current crypto, so you go and purchase the ticket with crypto, you purchase your crypto first, then you buy the ticket and you get the discount, that purchase will then be a personal use asset. So, obviously you've held it for a very short space of time. But anything that you're holding for anything longer, maybe a few weeks, or you've actually intended to make profit from it, personal use asset rule won't apply here. So it is actually in rare circumstances that you can use that one, which is a shame. It'd be handy to have a small kind of blanket exemption for disposing, or just being able to use it for spending. But at the moment, that's not the case.
Yeah, no, this is always one of those rules I've looked at, and I've just kind of stayed away from trying to do anything around it, because it's too many grey areas.
I think it's very rare that you can actually use it. I'm yet to kind of see solid examples where people have claimed under personal use asset rule. I know the ATO examples are, it's very clear that it would be a personal use, but in reality, these events probably wouldn't apply if you're holding crypto anyway. So yeah, it's just one to watch out for. Chain splits and forks. There was a big discussion around the merge and whether there'd be a fork, and it turned out to be a bit of an anticlimax there. But the basics of it is, if you receive additional tokens from a fork, those tokens have a zero cost basis, and there'll be capital gains on disposal. So the full value when you dispose will be subject to CGT. So it's not a great outcome there if you've received tokens as a result of a fork. Wrapped tokens. This one's an interesting one. So if you've wrapped tokens from ETH to WETH, for example, to use on other blockchains, current indication there is that's a taxable event. Now, there's a lot of community ATO guidance that suggests that this might be, essentially a coin-to-coin transfer, but essentially people are viewing that as the same asset. So should it really be a disposal event? And that's certainly something I brought up with the Board of Tax. And
this is one that I'm sort of, this sort of area here is, I think, where the current tax rules, I think, sort of don't fit the most. And I think it's just if you sort of step back and think what the intention of that kind of disposal rule is, like when you end your position in one asset and take up another one, that's a clear kind of capital gain sort of, no arguments there. But I think when it comes to things like wrapped assets and bridging tokens as well is another one that's very similar. where, in my mind, you're not necessarily disposing of your position. All you're doing is basically, there's different ways it works, but essentially just using that asset, you're making some changes to that asset so you can utilize some of the innate functionality that it offers, which is, DeFi or whatever else. So, again, it's around the intention of a disposal. Now, this isn't tax advice I'm talking about. I'm just talking about in general, just kind of theory. Whenever there's a confusing area, it's just standing back a little bit and going, what's the intention of that rule? And this is where I'm hoping some of the regulation comes in and sort of clears this sort of thing up. And again, bridging as well. So taking your Ethereum, for example, bridging it to AVAX, so you have a like amount of Ethereum on AVAX. Is it really a disposal? Yeah.
And that goes back to what I was saying earlier around people's experience on interacting with crypto and the tax outcomes, which don't necessarily align to how people are seeing the way they're interacting. So, someone wrapping ETH, they wouldn't think about that being a tax event because it's still their ETH. They still believe it's the same asset. It might just have some additional nice features so you can use them on other chains, but it's ultimately still ETH.
Yeah, and the interesting thing, we were talking about this before as well, is that as the kind of UX and everything gets better in DeFi, there's a lot of protocols where you'll take ETH and you'll put it in some sort of position, yield generating position, whatever it might be. But in the background, that protocol is actually swapping it out to wrapped ETH without you actually knowing. And then when you remove it, it does the same thing. So it sort of raises that question as well. It's not really reasonable for your average sort of crypto user to understand what's happening behind the scenes and then having to sort of wrap that back into their sort of tax return. So a very sort of hairy grey area, excuse me, that we're sort of looking at here with this one. So interested to see how it sort of plays out as well.
Yeah, definitely. And talking about grey areas, providing liquidity is another one. So, I think there's a general understanding of the guidance from the ATO that if you provide liquidity in DeFi applications, that is a disposal event. But it's not always clear cut, of course, because if you're providing, you can draw parallels to renting your investment property, right, or mortgaging it. And so, if you're using MakerDAO and your funds are held in escrow and you just repay your DAI loan proceeds essentially to get back your underlying crypto collateral, is that a disposal event? Should that be, do you change? And the test here is whether you have a change in beneficial ownership. And so, you can have a change in legal ownership, but you can still retain economic ownership of that asset. And we see that a lot with rental properties. So I think it's important to get some more clarity in this space. This is something that, a lot of the tax community that are engaged with crypto want to see more and more kind of understanding on. And at the moment, it's not feasible for everyday investors to go and do a full in-depth analysis on a protocol by protocol basis. It's just, you pay too much money for advice on that, and you might not be up for tax for that much anyway. So it's not worth investing the compliance resources to do so. But there's not clarity. There's not DeFi guidance actually out there in any formal capacity.
No, that's right. And look, we're just scratching the surface on the different things that you could call out related to that. But I think liquidity is interesting because, again, much like I just mentioned before with the wrapped ETH thing, and certain protocols just taking away that layer of complexity. So often you might have to split your asset into half of the original asset, half of another, put it in a pool. Then you might take it and put it in an auto compounder on top of that. But there's actually protocols out there that will batch that transaction and do it all in one hit. So if you start with ETH, you put it in with one click, and you pull it out with one click. So did you actually kind of split that asset?
Is it one or multiple? Yeah.
And I don't have a clear answer for that, but that's just one of many, and those use cases are kind of evolving by the day. So
yeah, and I sympathize with investors that are trying this technology out, wanting to learn from it, but coming to the tax time and actually figuring out that it's a real mess to understand what your obligations are, and your obligations might not always make sense to the way you would have thought they do, particularly if you're providing collateral and intending to regain that. So yeah, I think using Aave, A tokens are another example. If you have an interest-bearing token that you receive for depositing your collateral, what's the tax treatment for that? And you've obviously got a disposal event and then potential income generating activities there. And underlying all this is having to track it, which can become a nightmare.
And then, there's also, you got to laugh at some of the things like, some of the protocols now have got these self-repaying loans and everything like that. So if you take those assets, you've already done all that stuff to, and then put it in one of these protocols, what does that even mean? So
absolutely.
Let's see how it plays out, I guess.
And I mentioned there's limited guidance. At the moment, all we really have is general guidance from the ATO. We don't have anything in law per se. There's a draft law on the foreign currency rules, and essentially stating that crypto assets aren't foreign currency. That's still in draft. There's not really much robust legislation that we can go off, and so at the moment it's general guidance on the ATO's interpretation of the CGT law. So it'd be good to get some clarity, and I think we'll expect to see that following Board of Tax review, and I think that's something that everyone needs to get a bit of comfort when they do their crypto
What time
tax.
frame do you think we're looking at for that?
It's difficult because I think we obviously got the Board of Tax that are due to report to government at the end of this year. Whether that's still on track or not, we're not sure, but I think it will take a while. We're at least probably six plus months away from seeing some robust legislation. Obviously, when it comes out, it will come out in draft. There'll be consultation to that legislation, then that will be considered before it goes into final. And before that, we need to kind of hash out, DeFi, for example. I'm not sure if we're going to get solid guidance around that, but I think it's more just having a framework at which we can apply tax treatments that allow some kind of, wouldn't say flexibility, but simplicity as to how these taxing points arise and the number of taxing points, because at the moment there's far too many.
Yeah, I think I can't remember the name of the senator who put together some sort of proposal.
Andrew Bragg.
Yeah, it might have been, but I think there was some wording used along the lines of in crypto only recognizing the capital gains component when there's a clearly defined capital gains, and I think that might be something to do with the kind of disposal point I was making before, but. Yeah, I suspect just because of the complexity we're talking about, it's not going to be Rome wasn't built in a day, right? Yeah. It's going to take stages, but I think anything that kind of clarifies the current situation in a fair and reasonable way, of course, is a benefit, and then we can build from there. Right?
I think most people will welcome regulation and welcome having a framework to work with, because if you know the rules, you can play the game, right? As in we actually know what we can build on and what the regulations are.
Yeah.
As opposed to, speaking to someone from a DeFi association, and he's like, I don't want to write a line of code that I push out that may end me in jail. And he's like, I want to know the framework of what I can work with and how it's going to be taxed.
Absolutely.
And I think that's, it's clear, certainly from an Australian perspective, that regulation is coming. And most of the conversations I have, people accept that. And there's definitely a maturity there. I think particularly with institutions around the fact that regulation is coming. I think it's more around when and in what capacity and how that links to economic policy as well, because there's obviously a huge opportunity here. And I'm talking more generally than just tax, but tax is definitely part of it, because businesses will innovate in countries that are favorable to them from a tax perspective. If they have to worry around all their compliance activities and having onerous obligations when it comes to tax time, that will scare people away, particularly if there's other countries that don't have those onerous requirements. So that's
Dubai's having a pretty good crack at it.
Yeah, so you've definitely got different ends of the spectrum, and you've got the UK that have said they want to focus on it, but they're still implementing regulation. They did put out some DeFi tax guidance, and that's actually being debated or in consultation at the moment. Initially, it wasn't very popular. So, there's definitely different approaches, and so making sure that Australia stays competitive, I think, will be important. I also want to touch on airdrops. So I've put a separate slide for airdrops because there was a bit of a change here that upset a lot of people. So airdrops were initially taxed as ordinary income at market value when received. And there was a lot of confusion around this, because if I've interacted with a protocol in 2016 and as a result I get airdropped something of value, I'm suddenly up for tax that I've not asked for the airdrop. I didn't want that. It might be a marketing ploy or a marketing scheme. And so, the very fact that you actually can airdrop something to someone without their will and then having to pay tax on it, didn't sit well with a lot of people, and it was quite different to what you might see with other types of asset classes. And I think that's a very crypto specific niche.
Yeah, I think, but like I always try and put real world examples or analogies into some of the things happening in crypto. But the whole airdrop thing is like, you've got a letterbox, you put the no circular sign on it. Someone comes along and dumps a whole bunch of sort of advertising material in it, falls out of your letterbox, creates a massive mess. You get fined by the council for littering.
Exactly.
Right. It's it's obviously not the best match, but yeah. But then again, like there's plenty of benefits that come from really good legit airdrops, but there is a whole lot of shall we say trash out there as well, which people didn't ask for.
So what happened with airdrops was on the 7th of September. Bearing in mind you can start lodging returns in the first week of July. The ATO's guidance actually updated to suggest that where you've got an airdrop that's an initial allocation airdrop, so basically the first of its kind or the first distribution of its kind, then they're not taxable when received and treated as having zero cost base. So essentially now when you receive an airdrop, you're most likely not going to pay tax on income when you receive it. But when you sell that asset, you'll be liable for the full value of that asset. So it has a zero cost base. So if you sell that asset at $100, say, then that full $100 will be treated as the gain. And if you've held it for 12 months or more, you might get the CGT discount. So I think this is a welcome change, but I do want to touch on the point here is the way in which this guidance was updated did upset a lot of people because it was silent. The ATO didn't make an announcement around it. And obviously by the 7th of September, you've got people that have probably lodged their returns, those that are on top of things. And potentially they have to amend their returns and relodge. And it's kind of created a bit of a sticky situation, I think.
We met a gentleman when we did CryptoCon, did a panel, and he came to us afterwards and was like, it's not that the ATO didn't want to tell people, it's just that they're not very good at PR. And he was part of this change.
Yeah, right.
Yeah, I mean, the bright side is I think that's definitely a fairer way of doing it. And it's whereas, it is, if you get that zero cost basis for that sort of initial airdrop, it's only when you actually go to actually sell it and get value from it or do something with it that the tax side kicks in, which I think it's a lot fairer way of doing it.
And also initial allocation airdrops, I can see some issues with that wording because most airdrops by its very nature are initial allocation. You can argue that if you get dropped ETH, it's probably likely to be more of a staking type reward, or I'm struggling to think of scenarios where you've got an airdrop that isn't an initial allocation. I'm not saying that it can't be the case, but I think it's it's clearly around, well, we need to think about, is this term appropriate, or should it just be any airdrop is zero, and then making it clear what's staking, what's an income reward, and so on.
It's a tough one, yeah. I mean, there are some projects out there that do stages. They do an initial and then they do a following one, but it's part of the initial kind of token drop. It's just done in stages. So is that
exactly? So is that is that initial? Is it initial 1.2, 1.1?
But then again, I do feel sorry for the regulators trying to work this stuff out, especially the pace is changing. So yeah, there's probably, and some of these things, there's probably just going to be no perfect fit, right? Especially how fast things are moving.
So very quickly, obviously conscious of time, but if you're thinking of putting crypto in your self-managed super, or you have a self-managed super crypto holding, I just want to highlight that it's not as easy as just setting up a wallet and including that into your super return each year. Obviously super accounts have very, very strict rules on things like investment strategy. So are you allowed to actually hold crypto assets as part of your self-managed super strategy? There's obviously a very, very strict sole purpose test for SMSFs. So you obviously have the sole purpose that it provides you with retirement benefits. And that means you can't receive any pre-retirement benefit from it. And that's not even to say the compliance requirements with auditing and valuation, etc. So the reason I mention it is because I am seeing a lot more, and a lot of exchanges now as well are supporting self-managed super with crypto. And the ATO have actually said, I think self-managed super crypto investments reached over 200 million as of March 22. So people, and that 200 million, it's a small proportion. I think it was like 0.3% of total super. But it's just to say that, this number is probably going to rise. So it's worth just understanding that it's not as simple as just setting up a self-managed super and dumping in crypto.
So probably one of the most like heavily brought up topics for us when we're doing conferences is people coming up to us about self-managed super funds, how it's managed, how they can use crypto with that.
Yeah. So definitely seek advice if you're thinking of it from a professional auditor as well. It's very important that you jump through all those hoops correctly, particularly with the sole purpose test. If you've lost or had your crypto stolen, if you've made an actual capital loss, then likely you can claim that. I just want to highlight though that there's a number of things you have to provide as evidence, and you also need to make sure that you've actually lost the asset itself. So the ATO have actually said, here's what you need to prove if you lost or stolen crypto. You have to actually have made a capital loss. So some common issues here, we've covered these, so I'm not going to go into any detail here, but all I want to say is that all these areas that we've talked about where there's some uncertainty are areas that are currently being raised with the Board of Tax and government bodies as well. So these are all up for debate, and I'm sure when we do this next year, there'll be a very different landscape and a lot of developments to talk through. Some tips. So I think we obviously want to make sure that people understand when they hold crypto, 50% discount for holding 12 months or more. Record keeping, I think just use reliable software. The ATO have actually said on their record keeping tabs now that choose reliable software to record your transactions. Koinly is obviously one of them, but there's many out there. Loss harvesting, if you've made losses, you can offset them against future gains. But I think what's also important is use an accountant if you're doing complex transactions. Don't do it yourself if you're engaging yourself in DeFi, etc.
That's probably the most important one on there that I see is like go to an accountant and get some advice.
Okay, and just software providers. I think I think from a record keeping perspective, you've got to keep records for at least 5 years after tax return filing. A great way to do that is to use software. But I think it's just something to highlight that you may be asked for your records by the ATO. It's not just crypto, it's anything you disclose on your tax return. And so here's what you need to keep for crypto. It's essentially the dates, market values. Rationale for the transaction is helpful, and actually Koinly have a section in their transactions tab that allows you to put a description of your crypto assets in there. So you can document notes for what your transactions are, and it just helps understand, what was your intention? Is it a personal use asset genuinely? Are you running a business, etc.? And we've covered the challenges. So I think what we might do is just go straight on to some Q&A. I know we're short of time.
Yeah, we're running short on time. We've had a few questions come through on YouTube that I'm watching here. We had a question here that someone said that they're not planning to touch their crypto portfolio, and this is from Australia, 2635. And so they're not planning to touch their crypto portfolio. They're looking at it as a long-term asset. What's their situation with the ATO? I mean, I think
that's probably a very clear hodling strategy. Yeah. And in that case, it's actually probably the easiest way to manage your tax affairs at the moment. And the things you got to, if you're buying and holding in the long term, there's a couple of benefits. Essentially, you get that 50% discount when you go and sell if it's more than 12 months. But I think the main thing to watch out for is when you have income generating events. And that's something, as we mentioned, that people often don't realize. If you're staking, even if you're buying and holding, you might be providing liquidity. In that case, you might have actually made a disposal, so you're not buying and holding, even though you think you might be. So, particularly in the eyes of the tax guidance at the moment. So I think it's worth just understanding where you might be generating income and genuinely if you've bought to hold. But having said that, if you're just hodling, that's a great, a very, very clean way to manage your taxes, I think.
So I'll look here for another question for you. So someone actually had a specific question around how to connect their NFTs or wallets and different exchanges to Koinly.
Yeah.
And so I wonder if you want to talk a little bit about the API, but also the single sign-on.
Yeah, that's a great one. So should we talk single sign-on first? That's exciting. I think we should definitely mention that.
Definitely, yeah. So as part of our Cointree's partnership with Koinly, we have introduced single sign-on, which means from your Cointree account, you can basically go straight through with your Cointree log on and create a Koinly account. And we also have the integration that sort of brings across your transactions and everything, which is cool. So it just makes it, fairly, a few clicks to get things set up. I guess, a part of that other question as well, when it comes to sort of wallets and all that sort of stuff. I mean, one of the tips I learned of just, getting involved in some of the more, shall we say, experimental stuff is the way I go about a Koinly tax return is always add all your wallets in first. And there's multiple options. You can browse through the wallet section. I don't know if you guys want to talk about it in more detail, but do the wallets first, get them all synced, whether it's an exchange or whatever it might be, and then go ahead and look at your transactions.
Yeah, so I think Koinly software is only going to be as good as what you put in, and so you got to make sure you include all your wallets, all your exchanges. And what a lot of people don't realize is it's not just the wallets and exchanges you've used in that tax year, because you might have purchased the original asset in, say, 2015. You might be sitting on a nice gain. And if you only plug in what you've interacted with in that tax year, Koinly can't then go back and track your purchase history at that point in 2015. So it's really important to actually connect all your wallets almost from the beginning of time so you can work out the full value of the gains. In terms of wallets and integrations, obviously most of your exchanges and DeFi wallets, etc., will be covered in Koinly, so you can usually connect that through API. API is the easiest way to connect up because you could get a more real-time basis of where you sit, both with your portfolio tracking, but also with your tax reporting. But if you don't use API, you can also use a spreadsheet upload as well. So an Excel file works well.
Well, I think we're coming up on time, and I wanted to just take a few minutes to say thank you for Andrew for being here and for even Cointree with the single sign-on integration, because it was really great to be able to deploy that new technology, go out to market with it. We want to try and make our integrations as seamless as possible, and it's just providing that smooth UI and product transaction for the customer.
And I think it goes to, if you were to do this on your own, the hoops you need to jump through or the manual reconciliation that you need to do, even just if you use an Excel spreadsheet to do your taxes, I think it would be a genuine nightmare to record. I'm just thinking of my trading transactions for the year, like recording that. It's probably manageable on shares, but for crypto, the way people trade so seamlessly, it just becomes an absolute nightmare with high volumes and DeFi, etc. So it's great to be able to have something like single sign-on, which just makes that process so much more seamless.
That's right, yeah. And like we've spoken about before, depending on how sort of deep you are with transacting on-chain and how many transactions you're doing, right now it is crypto tax can be a challenging thing. So anything we can do to sort of make it easier, that's what we're looking for. So that's why we partner with you guys and get that integration up.
And before we sign off, we've got a few offers that we want to give out to our customers and listeners today. So if you haven't done your taxes yet and you want to use Koinly, then we're giving away 500 free reports to the first 500 customers, and then 30% off thereafter. So when you're checking out for your report, just type in Cointree 22LS in caps, and that'll generate a discount for you. And I think there's
and to sort of match that offer as well on the Cointree side, we've got with that same code, we've got a 30-day trading free, fee-free deal as well. So yeah.
So we'll also put it in the description, and so the first 500 people to use the code will have both a free Koinly report and 30 days of free trading on Cointree for new and existing members. Awesome. Guys, it's been a pleasure to do the podcast with you. Danny, thanks so much for the education. It's always a pleasure when we do these. And Andrew, thanks so much for being here to talk about the Cointree side.
Not a problem. Thank you, guys.
Awesome.
Thank you, everyone.
Thanks
tuning in.
everyone
Cheers.
online.